ladies and gentlemen, and welcome along for our next Financial Advisor Deep Dive webcast. My name's Mark Stubbings and I have the pleasure of being your host today. And as you'll recall, we've been running these webcasts for a very specific reason, that is around providing openness and transparency in regards to predominantly our unlisted asset classes. In previous webcasts, we've literally peeled back the onion on property, infrastructure, and also our private capital. If you want to access copies of those webcasts, we have recordings on our website, the Sunsuper website, under the tab of Advisor Webcasts. Today, we're actually going to be looking at our alternative strategies. And reasonably shortly, I'll introduce our speaker today, guest speaker, Bruce Tomlinson, who is the head of alternative strategies. Just to give you a little bit of a anticipation of what's coming in the future, the final webcast, because today is 4 in a series of 5, the final webcast is actually on a listed asset space. It's our equities, including our index options. Let me give you a little bit of an idea of what to expect today. What we're going to do when I introduce Bruce is going to lead us through a foundation presentation on obviously alternative strategies. It'll be a little bit of an anchoring presentation. It'll form the basis for Bruce then next to consider some questions that we've already received from a broader audience, and Bruce has obviously had the opportunity to prepare some answers and some slides. After that, we're going to go to live questions, and I have with me in the studio today Will Burke, and Will is going to curate the questions for me, and we're going to present those to Bruce. Please put your questions through. We'd look forward to answering those, or Bruce will look forward to answering those. And if we don't get to all of them because of time, what I can promise is the business development team will follow up. So please put your name, your email address, and we'll certainly follow you up to answer those questions. Just in terms of the housekeeping, if you look at the bottom right-hand side of your screen, there is a small speech icon there. Use that to ask your questions. And as I say, we'll get through as many as we can. Also, if you have any technical difficulties, there is an I icon there as well, which you can press for any technical assistance. Just by way of a disclaimer, today is obviously a general presentation and it doesn't focus on any specific individual's goals or financial circumstances. Let me introduce Bruce Tomlinson. Bruce is head of alternative strategies at Sunsuper and joined the organisation in 2007. Bruce has actually had 30 years in investment, 21 years as a portfolio manager, so you sort of get the sense he's probably got the hang of it by now. Aside from Sunsuper, he's also had some time at AMP Capital and others, and when you look at his geographic footprint, he's been in London, Boston, Sydney and Melbourne, which is pretty impressive. From an educational point of view, Bruce has a postgrad certificate of management, an MBA, a Bachelor of Architecture, which we sort of thought was a bit strange, but there is a reason for that, and he's also a CFA, a Chartered Financial Analyst. Bruce also serves on the investment committee of the Future Generation Investment Company. So ladies and gentlemen, I'll now pass over to Bruce to talk about the foundation presentation. Thank you, Bruce.
Thank you, Mark. It's my pleasure to be with you all this morning on this webcast. So alternative strategies is almost a $4 billion portfolio of alternatives at Sunsuper, and it makes up between 5 and 8% of the diversified options that your clients invest in. And we characterize alternative strategies as having a number of features or characteristics. It includes a mixture of liquid and illiquid securities. there can at times be some concentration of the assets. Interestingly, there is both long and short exposure. The portfolio does invest in multiple asset classes. So it invests in both equity and credit securities. And specifically, we're targeting a illiquidity and a complexity premium over and above traditional public market assets. So as I mentioned, it is both public and private securities, and it is an opportunistic portfolio. There is a core focus on credit investing, and I'll talk a bit about the exposures and the strategies below that. And then we have some diversifiers to balance that out in certain sectors such as equity long short and macro investing. Next slide, please. So the alternative strategies portfolio invests both in pooled or commingled funds. So we're investing with other investors in a portfolio or fund, and we also invest directly, both via co-investments and then direct individual assets. As I mentioned before, it is an opportunistic or idiosyncratic type portfolio. We are looking for capital constrained, outcome oriented situations. So a situation where Sunsuper's capital can help affect an outcome and help drive a return outcome. We do access globally, the best managers globally, and we focus very much on the people running those firms and the alignment with those people. So for example, we want them to be invested alongside us, to have a significant amount of their own net worth invested with us. We also look at the incentives and the alignment. As I said, we prefer and have a majority of the investments where performance fees are what we say is back-ended. So the fee isn't paid to the manager until the investment is realised, and that there's also a hurdle over and above which they need to deliver a return before they've paid their performance fee. So that improves the alignment. The benchmark is essentially cash, US cash. We do have an outperformance target of 4%, and this is after all fees and expenses. Next slide, please. Now, diversification is a key part of the portfolio management process. We're diversified in a number of ways. Initially, it's by strategy. And so this slide shows the different components, the strategy components of the portfolio. And as I said, credit is a core focus. About 70% of the portfolio is currently in credit, but that is very diversified. So there's a mixture of public and private credit and a mixture of investments either in funds or directly. And so this slide, you can see that there's 20% in co-investments, another 10, 11% in direct investments. And we do those more direct investments for a number of reasons. The alignment is better, generally speaking, because we are upsizing or co-investing with the manager in their highest conviction positions in general. We also get lower fees through co-invest and direct investing, significantly lower fees than in a fund. There's more transparency, and ultimately there can be more control for Sunsuper and even some governance rights in some instances. So that's why we do the co-investing and direct investing. So credit is a core. We then balance that out with some diversifiers. Macro is something that Sunsuper has done for 12, 13 years. So macro is investing in rates, FX, commodities at times, long and short positions. And then equity long short is also a diversifier. The diversifiers are generally more liquid than the credit and event special sits investments. So that blends out the liquidity and the opportunity set. Next slide, please, Will. So again, more diversification, and this time it's by geography. So as I mentioned, it is a globally oriented portfolio. There's only less than 5% in Australia. A lot of the capital is in North America, as you would expect, given the size of their capital markets, but it doesn't dominate the portfolio. It's 45%, so 55% is outside of North America. There is a fair bit of investing in Asia, particularly North Asia, China specifically, and then another 20-odd% in European opportunities. So well diversified by geography, primarily developed markets, but to some extent emerging markets as well. Next slide, please. And then the third aspect to diversification is by industry sector. And this chart shows just how diversified the program is. There's no industry sector that's more than about 20% of the exposure. Those largest exposures are in real estate, industrials, which can include transportation, does include transport assets, aviation, shipping, etc. Utilities is another sector where we have and energy, so energy and power, that's 12-odd%. And then there's smaller exposures to a bunch of other things, including consumer, healthcare, financials, etc. There is a bit of a focus on real assets, things like real estate, energy, transport, but it's well diversified. And so the last slide in my little set piece shows our cumulative returns, our performance over the last 12 years. And we have achieved that performance objective of cash +4 net of fees. The COVID period, the first quarter of this year, was a challenge, but the performance has started to recover, and so we look forward to recouping those losses in the next year. So I'll hand back to you, Mark, for some questions, please.
Thanks, Bruce. That was very informative. Thank you. Now, let me ask you a question, Bruce, and these are the ones that we've obviously received beforehand, so we've been able to prepare for. Hedge funds are pretty high profile, but there's a perception that they're expensive, that they haven't performed well. How would you reply to that, Bruce?
Sure. Good question, Mark. So the portfolio has evolved over the last 12, 13 years since we set it up back in 2007. It was predominantly hedge funds a decade ago. It isn't predominantly hedge funds anymore. In fact, it's only about a third of the capital. And yes, to your point, Mark, performance has been mixed. Fees have been high. Performance is uncertain, but fees and expenses are a certainty. And so we have decided over time to gradually shift our capital away from those hedge fund sectors predominantly and move into some of the areas that I mentioned in credit in particular. We've found better opportunities really since the GFC and into the 2010s. As banks have pulled back and had additional regulatory capital constraints placed upon them, they have been less willing to fund various companies, and so these bank replacement credit strategies have been a place where we have shifted some of our members' capital. And we found that in general those slightly longer duration credit investments have had lower fees, they have had performance fees over a hurdle, and also performance fees that have been when investments have been realised. So what we call back-ended fees, they're paid later rather than sooner, which all ends up compounding to higher returns for Sunsuper's members. So yes, we've responded to mixed performance and high fees in hedge funds by shifting capital away from that space. And an example I think is, I think you have on the screen there, Will, the Norske Skog paper mill. That's one of 7 paper mills in this company, which is in Norway. The company's based in Norway, but they have 7 paper mills in Europe and Australasia, Australia, New Zealand. So this was an investment which is a credit investment. It's through a manager based in London. This business, clearly paper manufacturing, paper for newspapers and magazines, is in structural decline. The company was over-levered. Their debt traded down, became what's called distressed. This manager bought this debt. The company went through a bankruptcy and a restructure. There was a debt for equity swap, and through the manager, we ended up owning this company. It was private for a while. it was rehabilitated, the balance sheet was fixed up, and then it was IPO'd in the third quarter of last year, and we made a nice profit on that investment. We've sold down some of the exposure in the IPO. We've still retained some exposure. It's quite an interesting company. While you might think that manufacturing paper for newspapers is a dead industry, what you can do with a paper mill is actually convert it to fiberboard, which is a constituent part for cardboard boxes. And of course, cardboard boxes is a growth industry because people are purchasing from Amazon and shipping goods to their homes. And so it's an interesting company, and we bought into it at a cheap price, and through that restructuring and IPOing process have generated some good returns for members. So that's an example of, it's not a hedge fund strategy, it's more of a special situations credit strategy.
Fascinating, interesting story, Bruce. The alternative set, there's a lot of opportunity, it's pretty large for obvious reasons. Do you think you have sufficient resources to take advantage of that, Bruce?
Yes. Thank you, Mark. Yes, look, it is a wide opportunity set, and I think one of the slides on the geographic exposure showed we had about 5% Australia, 95% ex-Australia. So it's a very global portfolio. The team, we were very fortunate to add to our team in February, just before the shutdown, and so the team is now 4 dedicated full-time professionals. We hired someone with a credit specialisation. They'd worked at an insolvency restructuring firm, and so they really add some depth to our credit underwriting. In addition to the 4 dedicated in my team, we work very closely with the private markets team. That's Michael Weaver's team. Some of you would have listened to the previous webcasts on those other alternative asset classes. And Michael's team has another 13, 14 people, and we work closely together. For example, if we're looking at a real estate credit or an infrastructure credit, we will work closely with Michael's team, and one of their team members will join us to help underwrite that investment and to help really challenge the pros and cons, and to make sure that it's the right investment, and then we look at it on a relative basis across different opportunity sets and different asset classes. So the team really is bigger than just the 4. In addition, with resourcing, we do work with a number of advisors. We have a specialist alternatives advisor called Axia. We also work with the Stepstone Group for some of our real assets. And then finally, if we make a direct or a co-investment, we can engage technical, legal and accounting advisors to help us underwrite that investment if we're going to take a direct stake and end up owning a piece of that company directly. So we think we have sufficient resources. And then I guess the only thing I'd add, Mark, is that we do select managers who have a global reach. So they're not just in 1 or 2 places. For example, we have a manager who's based in Hong Kong, but this manager has another 7 offices in the Asia Pacific region. They've got 2 offices in mainland China, being Beijing and Shanghai. Just as COVID was happening, they sent one of their key people from Hong Kong to Shenzhen, who's been based there for the last 4 months, and this person can now travel freely within China to look at some of the real estate assets that we've invested in there in China. And so having managers that have enough capacity and enough breadth and depth, and having local offices means that, even with the lockdowns in COVID, the managers still have that ability to visit assets and to engage directly face-to-face with counterparties before making, important investments. And sorry, I should point out, there is a slide. So this slide shows the Tel Aviv Stock Exchange. And just quickly, that one was, I guess this shows the breadth of the investments. This was through a specialist manager based in New York, who has done a number of investments in financial exchanges, investments in things like the ASX and Deutsche Börse and the London Stock Exchange and the New York Stock Exchange. So they had a capability in exchanges, and The Tel Aviv Stock Exchange was a mutual. It was basically owned by a bunch of Israeli banks, and it was essentially a private company. The securities regulator in Israel wanted the exchange to step into the 21st century and to facilitate, capital formation and capital raising in Israel and to allow companies to grow. And so they said, we want this mutual demutualized and to be brought into the 21st century with better governance and with a more efficient capital structure, and to improve the services and to facilitate the growth of the Israeli economy. And so through our manager in New York, we invested in a small piece of this company when it was going through the demutualization process, which was quite complicated. And then ultimately this company IPO'd late last year, and I'm pleased to report that it is trading very well. They've increased turnover and trading activity, which increases the fees paid to the exchange, and that business has performed very well. Being a public company, it did drop during the initial sell-off with COVID. It's now actually above its pre-COVID price level because it continues to trade and deliver good performance results. So that's an example, I guess, of the breadth of the portfolio and the diversification of the portfolio.
Fascinating story. Thank you, Bruce. I'm now going to pass over to Will Burke. Will has been obviously curating the live questions. So Will, over to you for some live chat.
Excellent. Thank you, Mark. And there's a question just come through, and it's really a point of clarification. Bruce, can you just confirm, or I guess clarify, the diversified alternatives investment option as opposed to the alternative strategies which you're the portfolio manager for?
Certainly will. So the diversified alternatives option is a diversified option. It has target allocations of 35% to private capital or private equity, as we also call it, 35% to infrastructure, and 25% to alternative strategies, including hedge funds, and then 5% is cash. That should add up to 100. So the diversified alternatives option has a component of the portfolio that me and my team manage, being alternative strategies. So sorry for that confusion. Yeah.
Yep. Thanks, Bruce, for clarifying that. And a question that we get all the time as a BDM team, so I'm glad it's been asked, is just around our valuation process for alternatives or for hedge funds, and including the frequency and the independence of those valuations. Absolutely.
So this portfolio is a mixture of public and private assets. It's roughly 50-50 at the moment in that mix. The public assets can obviously be valued daily, and for those investments that we've made, we receive monthly valuation statements from the administrators of those funds who are independent of the managers. In some cases, we do get estimates during the month, weekly and mid-month estimates, but they go into the unit price monthly, is my understanding. The private assets, we receive formal valuations from the administrator of those funds or the manager on a quarterly basis. In some cases, we do a monthly roll forward of that valuation to include expenses and interest accruals. And so the portfolio is a mixture of monthly and quarterly valuations. As I said, the portfolio is highly diversified, both by strategy, by geography, and by industry. And so those valuations are coming through all the time. And so it is, there isn't one asset that's going to dominate the valuation. In fact, the largest asset is about 9% of the portfolio. And referring back to that first question, alternative strategies is 25% of the diversified alternatives option. So no member would have an exposure more than, if they were 100% in diversified alternatives, which is unlikely, they wouldn't be more than 25% in this alternative strategies portfolio. So highly diversified, mixture of monthly and quarterly valuations. Yep.
Thanks, Bruce. Another question's come through just regarding the opportunities in the market for alternative strategies to hedge funds, especially in the COVID environment we're now in. What are the opportunities like at the moment?
Sure. Yep, very good question. So, look, there's no doubt we're still really in the early stages of this kind of COVID world. I don't even want to call it post-COVID because we're clearly not in a post-COVID world. So we do tend to think though that credit will continue to be a very rich opportunity set. You know, when there's economic stress and fundamentals are struggling, in general you want to be a more senior part of the capital structure, and credit should do better than equity in a kind of distressed or recessionary environment. And credit is a core part of what we do. Like I said, 70% of the exposure, and we've hired specifically to boost our capabilities there recently. In terms of the credit opportunity set, what we saw in March and into the second quarter was, particularly in the public credit space, so in high yield bonds and bank loans, the market priced down, it gapped down in line, in the same direction as equities. It didn't fall as much as equities, but it did fall. And then it's somewhat recovered. So that first phase really was sort of stressed public credit, having various issues, people concerned about credit quality, people concerned about whether bonds would be downgraded, and the corporate's ability to repay that debt, their debt obligations. What we think will happen now as we move into the second phase, which will probably go from now for a good year or perhaps longer, is there'll be refinancings of capital structures. In some cases there'll be sort of rescue financings where there might be haircuts on some of the existing debt will be repriced. Some debt might become equity in order to reduce the debt burden for those corporates and help their ability to repay those obligations. So there'll be some refinancing, some rescue financings. And then we'll probably move into a third phase where there'll be, some more stress, bankruptcies, defaults. I appreciate we are seeing that, in a few pockets right now. Obviously, we're all aware of the Virgin Australia bankruptcy, and there are some bankruptcies in some other select areas, but we think it's going to take a while, 6 to 12 to 18 months before we really see some of that sort of second order effect coming through. And so we'll be looking to invest with existing and perhaps some new managers who have broad capabilities to invest across that sort of credit opportunity set, to move from stressed into distressed over time. Managers that have the capability to work through restructurings, to lead creditor committees in bankruptcy situations, to be able to bring in capital, including our capital, to help make an outcome such that we can generate good returns on that capital over time. So that's the way we see it unfolding over the next couple of years, but there's still a lot of uncertainty out there.
Excellent. Thank you very much, Bruce. I'd love to get to a few more questions, but we are running out of time, so I'll hand back to Mark.
Thanks very much, Will. And Bruce, just before we sort of wind up, time is running out. Maybe I could get you to just summarise your thoughts in a nice, succinct way. Why would alternative strategies be good for advisors and, more importantly, their clients? What would be the compelling arguments, Bruce?
Okay, thank you, Mark. Look, I would summarise the why would you do it question. There's a few reasons. We expect to get a return premium. Otherwise, why do it? That return premium should come from the illiquidity and the complexity of these assets in this opportunity set. So there's a return premium over traditional public assets. These investment opportunities are also diversifying in that they can invest in sectors and in companies that are often not found in the public markets. And that diversification will reduce the volatility overall of your clients' retirement assets. And then finally, generally these are actively managed strategies, and that active nature should generate some additional value over and above a more passive approach. So really, yeah, it's about a return, premium, diversification, and reduced volatility. And when you put that as a building block into a broader portfolio, as Sunsuper does in the diversified alternatives option or in the balanced growth other diversified options, it can help deliver higher risk-adjusted returns for your clients.
Excellent. Thanks, Bruce. And Bruce, also appreciate your time today, the explanation, and obviously dealing with our questions. I'd also like to thank our listeners for dialing in for today's webcast, and just a reminder that obviously there's a suite of resources on our website. We'll actually put the link up fairly shortly on the slide, and also all of the previous webcasts are on the website, as I mentioned, under the tab Advisor Webcasts. What to look forward to from here? There's one more webcast in this series to go, which is on our equity holdings, including our index options, which we obviously source through Vanguard. If you want to register for that, there's going to be an email coming out shortly. That email will send you a copy of today's recording. It will obviously give a link to register for the last in the series. Also importantly, it will contain a survey so that you can complete that to claim your CPD points. So ladies and gentlemen, Bruce, thank you very much for listening today. We appreciate your time. Enjoy the rest of the week. Thank you.